Okay, stock market, S&P 500, SPY, building the intermediate analysis. So I'm going to take you through some step-by-steps in here of when I begin to look at a chart and how I evaluate the chart, how I see the cyclical patterns in there, of course, with my trained eye, and want to teach you how to do the same thing. And of course, you can always take our cycle analysis workshop and go to the front page under workshops, and you can see some details on that and a free video on what that looks like. So we're going to take this step by step, as I say, and then there'll be a second phase to this in the level 4 special I'm going to offer following this, where I look at our proprietary indicators running live, and you'll be able to get a sense for the multiple time frames. Right now I'm going to focus on the weekly chart looking at SPY. So here is the SPY chart, and you can see there, looking at it, that it's basically a general candlestick that you may see. Now there's a couple studies on here. First of all, we have 2 moving average. It's the 13 and 34, a week simple moving average. That is what we like to use on our weekly chart. And generally when they're configured in a positive way, where the 13 is above the 34, it's a positive condition, and when they roll over and cross over, then you get into a more negative condition. Often, the 13 is a support, as you see right in here, or a resistance. When it gets very far from that 34-week moving average, which it did right here at the pandemic bottom, it often comes back up to it. Now, if this continues to move down in here, eventually it'll come back and tag that 34-week moving average. So that's just a sense for what we have in here. Also, we have our reversal scout, which is our momentum indicator, and also an indicator that helps us identify the cyclical patterns that are in here. Of course, cycles are measured from trough to trough, or low to low, and often they have very common lengths within the cycles. When you have a market that is very skewed in one direction or the other, sometimes they're tough to read, and sometimes when there's good volatility, they're easy to read. And you're going to see that in here as I move to the next slide. So we're going to look here at slide number 2, and here you could see we're adding in cycle brackets. Now, what we've identified looking in here is that there is a dominant cycle right over here. Cycle, again, is from this low here at the pandemic bottom. The dominant cycle right in here is 26 weeks. So it's this period right in here is 26 weeks. This one right in here is almost unidentifiable. This is what we say when a cycle goes invisible or swamped, when it should be in a corrective period, as you saw right over here, but it doesn't really have a measurable decline, just this little one right in here, which isn't very readable. And that happens in very strong markets. There were 1, 2, and 3 of those with swamped type looks to them. And then you can see right in here, the low right here and the low here were much more readable in this same pattern, as you see. Now, I'm going to move to the next slide in here, and we're going to get more and more information. You can see as I do this how we start to look in here. So now I've put the actual dominant cycle lines on the chart on top, and you can see how this, which is the ideal cycle, this is not actually cycles, this is just a guide to help us understand the length in here, which from this low to this low is about 26 weeks. The average cycle is what we really look at. They're never going to be perfect, but you can see 1, 2, 3 rising cycles, and then a cycle that actually brought the peak, and a cycle that brought the bear market that we're in right now. Now, we believe this is incomplete, and I'll show you more about that as we go forward. You'll also note how the reversal scout traces out that cycle beautifully in here, as it did in here, but not as clear because of the upward pressure that was in there, and that you see that in this 13-week moving average, and then it rallies and then rolls over again very early in here. I'll talk more about what that means when it peaks early here. Then it started to come down, and based on what we see in here, there's an indication that this decline is not over with, because the length takes it out here to September or early October. Show you a little bit more about that as we move to the S&P 500 again with more information. And now you can see I've added in the minor cycles in here, which are the 13-week up on the chart, and you can see how they resolve themselves, and also added in these vertical cycle lines, which are the actual points that the cycle's bottomed. So you can see in here this was pretty perfect. This bottomed early, which by the way often happens in a rising market. Declining markets tend to bottom later. This one a little bit long, as you can see. This one pretty spot on, not bad. And this one points to, and you see these two vertical lines right over here. That's a low maybe late August to early September, all the way out over here to early October. So this is where we're starting to get that September, October, and one more downside move. You'll note that this minor cycle right in here is forming that rally a bear flag. Now, this is what happens when you have a big downward momentum in here, and then the minor cycle pushes up. It can't go very far because the dominant pressures are still to the downside, and that's how you build a flag like this. Actually, if you take our cycle analysis workshop, module number 9 talks about how cycles actually build these patterns, and you learn a lot by taking that. So this right over here shows a flattening out right over here of momentum. It's improving a little bit, as you can see, but then there is risk over here when this market turns down that it's going to get sold again and come down to, well, to some reasonable projections, which I'll show you in just a moment. So you can see in here the clear added minor cycles. You can see the dominant cycle lines and how the cycles do have averages in time that are fairly close. The principle of variance says that it will vary by some amount, and usually it's 3 or 4 bars in either direction. And if it varies beyond that, then we know that there is some shift going on. And then we look at how to analyze the energetic shifts that are happening. There is so much incredible information that you get by this style of analysis. Here you can see right over here is the next phase in here, and I'm showing configurations and cycle translations and the head and shoulders top as that formed. So this you can see are the what we call configurations. As right in here the market was moving up, each of these cycles were positively configured. Each of them peaked on the right side of the cycles, which means that they were positively translated. When you have a positively translated cycle in a bullish configuration, that says the next cycle will go to a new high, as it did here and here and here. But look what happened here. This configured negatively, and that said there was a major top in. When you got the rally and hit resistance and then came down and broke, well, that made your head and shoulders top. Now we're getting a head and shoulders measured move down over here, which is to about, well, 320 or 325 on the SPY. Also, you can see in here this flag in here still, and that's likely to turn down and move down into this area. So you see the translations turn negative. That essentially took your uptrend right in here and made it into a topping and into a negative trend, as you see right over there. You'll see more of that as we move into the next stage. Here you could see our projections in here and what really happened. Government stimulus was extreme valuations. You got up to 200% S&P 500 to GDP. It then began to roll over, made this head and shoulders top, and you have this downward motion in here, and the measured move down over here to about 3,200. We also have, that's 32 on the SPY, 3,200 on the SPY, on the SPX, and there's also important supports that occur somewhere around 350 in here, and then down at that 3,200 level. So you can see in there that the Fed withdrawal stimulus all of a sudden brought that decline in here, the head and shoulders top, and you can see these yellow areas right in here. Those are the actual periods of risk. where each of these declines should come. When you have this big upward momentum, they're not very strong. When the momentum changes to negative, they're strong, and that's why we think there's a strong decline coming right there on the downside. So that's a look at the SPY. And the last one we're going to look at right in here is these final projections down to these supports, and the fact that there is another rally likely coming right out over here. So that's a good look at, where you get this bottom timing here in September, October, and then these next cycles over here, which give you a rally. We actually think that bear market low is at the bottom of this cycle, which is in early 2023. Everybody thinks that the lows will come somewhere in here and the new bull market will resume or has resumed, but looking at this, you could see the probabilities of that are very low. So decline into September, October, and then the likelihood of some kind of a move. 350 on the SPY is reasonable. 320 on the SPY is possible in that time. So that's how we get this analysis that we referred to in the S&P 500 and building into that analysis. And I hope you found that very interesting.